Hey everybody, Brad Gatto here, one of the managing partners at Fiat Wealth Management. And I wanted to bring you a quick concept today that we think is one of the most overlooked areas of comprehensive financial planning. Doesn't matter if you're a do-it-yourself or you're managing your own money or you have a long-standing relationship with an advisor, we see this as an area of opportunity for most people. And so in our hypothetical example today, we're going to look at buying ABC company stock. The next decision that you have to make is the tax decision. Do I want to buy that in a pre-tax account, a tax-free account, or an after-tax account? Now, as we all know, ABC company stock can only do two things, right? It can only go up in value, represented by the green, or it can go down in value, represented by the red. Now, of course, we only buy it because we want it to go up. But let's look at both scenarios. So if we buy ABC company stock inside of a 401k or an IRA, that's bought with pre-tax money and grows on a tax-deferred basis. But if it goes up in value and down the road we go to spend that money, the question is, how am I taxed? The answer to that question is ordinary income, just normal ordinary income rates. And I've got written out here the current rates in our code. If it goes down in value, there is no tax implication. You're just going to lose money. Obviously, when you pull that out, you're still going to be paying ordinary income. Tax-free. In order to buy ABC company stock in a tax-free bucket, I have to use after-tax dollars to purchase. And then if ABC company stock does go up in value, I do not pay a dime of taxes on that growth. It is a tax-free bucket. If ABC company stock goes down in value, same thing here, I lose money, there is no reprieve. Lastly, another after-tax bucket, so similarly to the tax-free bucket, I have to use after-tax dollars to buy in. Difference is, if it does go up in value and I'm right, and I go to spend that money down the line, I'm going to pay long-term capital gains rates, not ordinary income tax rates. Those are 0, 15, and 20%. The bottom line is, this tax bill is different than this one, okay? This one, 99% of the time, is less than this one. I call it preferential tax treatment, okay? If it goes down in value, also a unique bucket in the fact that you do get some reprieve. As you can see in purple, you get to write off some of those losses. You can use losses to offset gains. You can bank losses at the end of the year. The bottom line is there is some tax planning that can be done around this after-tax taxable bucket. So really, if you're going to lose money, none of us want to lose money. If you're going to do it, and you could cherry pick which bucket it should be in, it should be here. The last thing I'm going to point out about the taxation of the buckets is what happens to these buckets if I die. And the money goes to my kids or grandkids or somebody in my family. At death, the pre-tax bucket is going to be taxable to your beneficiaries at their tax rates, their ordinary income tax rates. The tax-free bucket remains tax-free, and then the after-tax bucket is again unique in the fact that it gets what they call a step-up in basis. So if you had bought ABC company stock for $10,000 and it was now worth $100,000 and you sold it while you were alive, you're going to pay long-term cap gains rates on the 90 grand. If that goes to your kids, they get to step up the basis. In other words, they get to inherit it as if they paid 100 grand. If they sell it and it's still worth 100 grand, they don't have a tax bill because there is no gain. So there's some unique things about these buckets. So if you're following along at death, ideally, you want to be able to leave either the tax-free or this after-tax bucket to your beneficiaries. Last point, hang with me. I'm going to draw a dotted line right here. We spend a lot of time building out investment allocation and a lot of energy building out investment allocation. But have you ever thought about where you buy that investment from a tax standpoint has a long-term impact on the overall outcome of your portfolio? What I mean by that is this. If I draw a line this way, it seems to me the IRS is incentivizing you to take your risk over here. Because if you take risk, you're hoping for gains. And if you're right, in these two buckets, you get to keep more of it. Okay? And so if you have a diversified portfolio where some positions are riskier than others and some are more conservative than others, from a tax perspective, it makes sense to take your riskier investments here and take your less risky investments there. Lastly, if you enjoyed the content today, I want to let you know you've got a couple of opportunities to interact with Fiat Wealth Management. The first of which is there's a link below the video. That link is going to take you to a calendar and allow you to schedule a 45-minute visit with a member of our team. That 45-minute visit is just an opportunity to get acquainted, nothing more and nothing less, and we can answer any questions you may have about the concept today. The second link is an opportunity for you to get an expanded version of this type of education. We put on online educational workshops. They're 90 minutes in length, and we spend that entire 90 minutes giving you free education on tax implications of your overall financial planning. Thanks for joining us today. Hope to talk to you soon.